Welcome back to another episode of Palisade Radio. I'm your host, Karem Mamutlu, and on today's show we have David Rosenberg, who's the chief economist and strategist at Gluskin Sheff and Associates, who are an independent wealth management firm based in Toronto. Welcome to the show, David.
Thank you very much.
Let's begin by talking a bit about your background, David, and how you started your career, and also give us a sense of what kind of approach you use for when taking a view on the markets. Do you use a mixture of fundamentals and technicals, or is what you're after mainly value-based in your approach?
Right. Well, I actually got my start on Bay Street in Toronto as a financial economist at the Bank of Nova Scotia on October 19th, 1987. So for those that can remember, that was the day of Black Monday. And it was actually, in retrospect, a really auspicious way to start my career because it taught me the difference between a bear market and a correction, and also taught me about how important liquidity is as the oxygen tent for the financial markets. So got my start in 1987 at the Bank of Nova Scotia, moved on from there to the Bank of Montreal, BMO Nesbitt Burns in the mid-1990s, and then I guess the really big inflection point was starting at Merrill Lynch in early 2000. My first couple of years in Toronto was the chief economist and strategist for Merrill Lynch Canada. And then I got the keys to the kingdom and became the chief economist in New York in the fall of 2002. And I think that when people ask what were the keys to success in this business, it was basically not just stopping as an economist and calling the GDP forecast, but taking your macroeconomic call and always attaching a market call to it. So I think that, there's different types of economists. There's economists in academia, economists in central banks, economists at the Conference Board and the Brookings Institute. But if you're going to be a street economist, your role is to help investors make decisions. And that means that you have to attach a market call to your macro call. In terms of, how I evaluate the marketplace, and this is just the benefit of doing this, for over 3 decades, I think that you have to take a very eclectic approach to the situation. You almost have to be like a Tom Brady and be able to see the entire field. Very holistic approach towards investing, which means that you can't be stubborn, and you have to take a look at your blind spots, and you have to be cognizant of everything that's happening on the playing field, which means that you have to pay attention, as you said, to valuations. Obviously, as an economist, earnings fundamentals are very key. But as I said, I started in this business in October 1987, when even with 50% earnings growth and 7% GDP growth and cycle low unemployment, we still had a horrible quarter for the stock market, and symbolized by the worst one-day decline since 1929. And that's because liquidity plays such an important role too. You can't just look at the fundamentals on their own. You can't just take a look at valuation on its own. You have to take a look at liquidity. You have to take a look at the technical picture. You have to take a look at sentiment because you have to know whether the news as an economist is good or bad. As the strategist, you have to decide from an asset class perspective how much of the good or bad news is already priced in. So you have to take a look at sentiment, you have to take a look at fund flows and market positioning and everything else that I already mentioned between technicals, valuations, and fundamentals. All those things are the ingredients in the stew that you have to really take a look at holistically to come up with an assessment of where things are going.
Let's focus on one particular market, and I'd like to get your current views on gold and silver. Do you feel that the time for investors to start looking at real assets that have yet to move in a meaningful way is upon us, regardless of the recent strength over the last couple of months in the gold and silver space? And within your career, have you seen similar situations in the past where commodities have been as unloved or as undervalued as they presently are?
Well, it's very difficult to evaluate, whether commodities are cheap or whether they're expensive. They're a little more difficult to value when you compare to looking at the bond markets or, of course, the equity markets. You can't do a dividend discount model on gold or silver. And so it's a little trickier. I mean, people like to look at sentiment indices. That much is true. I think that's important. And people like to take a look at various commodities in relation to global GDP and make the assertion that, well, we're hitting new lows and therefore this is a great contrarian play to turn bullish. A couple of things. The first is that there's different commodities and they respond to different factors. So, you brought up silver and gold. And I look at precious metals a little differently as an asset class than I will at, say, copper, nickel, tin, lead, and aluminum, which are much more cyclical. I think that the only reason you would buy, outside of, say, supply disruptions, which you can trade around, you're only buying industrial commodities if you have a very bullish view of global growth, especially in China. But the reason why gold has been behaving so well, and in fact has been behaving well in all currencies, not just U.S. dollar terms, in the past couple of months, is because of this pivot that we're seeing among the world's central banks. And it hasn't just been this dramatic 180-degree turn by Jay Powell, but you've seen the same in the ECB. You've seen a same shift in rhetoric among the BOJ. Australia, where I am in Toronto, one of the first central banks to pivot from hawkish to dovish was Stephen Polo's at the Bank Canada. So we are seeing an end to the interest rate cycle. Rising interest rates tends to be a negative for precious metals because that's the opportunity cost, is the coupon. And now coupons or yields are coming down. And so I think what's really changed here that's very interesting is expectations of monetary policy, the fact that we've hit the peak on interest rates and now they are rolling over. And we reached a situation now where just since last fall, the volume of bonds globally that are trading with a negative yield has gone up 16%. Back to $11 trillion. I mean, think about that for a second, that here we are heading into the 10th year of this economic expansion, and we're still so reliant on the central banks, and 20% of the global bond market is back trading with a negative yield. So that's the real bullish case for bullion. Is what's happening to global bond yields right now and to monetary policy. And my sense is that this will continue for some time. I think gold is back into the early stages of a bull market.
Excellent. Okay, David, give us a sense of any calls in your career where perhaps you have been very early in a market or the market has gone against your view for a while before your analysis eventually plays out correctly. I'd like to understand how the psychology of being right and sitting tight plays into your investment framework.
Well, I think that, we have to take a step back and evaluate the role of the economist or the strategist is to be a cog in the wheel for those people that are actually in the trenches managing the money for their clients. So they don't have the luxury of being as early as I have been. And so much more important to be a market timer or close to being a great market timer if you're managing the money. And certainly market timing has never been one of my fortes. I'm big picture, and I figure my role is to talk about the really big moves or what the big moves are going to be, the next big move across the asset classes, as opposed to telling people what week, month, or quarter that could happen. But basically, what are the risks out there? Because ultimately, if you're managing money, You're a wealth manager, but you're also a risk manager, and the role of the economist is to really weigh the probabilities because it's always shades of gray. There's no black or white. So it's really about how the probabilities are shifting, and also if there's going to be a big move in one direction for a particular asset class, what is it likely to be? So in answer specifically to your question, I think back to when I was at Merrill Lynch in New York, and missing out embarrassingly on practically that entire equity rally from 2002 to 2007. That was a 5-year rally that saw the stock market double. And frankly, when I got to New York and I started learning about all these acronyms, and about mortgage cash outs and option arms with negative amortization features and mezzanine CDOs, and I was witnessing firsthand in the States, being from Canada, where we're naturally much more conservative, but to see people in the U.S. treating their house as an automatic banking machine and, cash out refinancings to use for current consumption and cannibalizing your home equity to boost your spending. I just didn't think this was going to be a viable economic model or something that was going to lead to sustainable economic growth, but it did last for about 5 years. I was never a believer in that expansion. I didn't believe you could actually take this detonation of the technology capital stock in 2002 and then somehow take a detonated tech bubble that burst and then create a housing bubble on top of it. And it lasted far longer than I ever would have thought. It reminded me actually of one of Bob Farrell's market rules to remember, which is that exponentially rapidly rising or falling markets go further than you think, but they don't correct by going sideways. And this was a bull market and a debt-laden expansion from 2002 to 2007. It lasted much longer than I thought it ever could. And I was issuing warning signs way too early. I was talking about the housing bubble at least 2 years before it collapsed. I look back and I say, well, if somebody was warning somebody in 1927 about the 1929 collapse, I think historians would actually view that as a pretty good call, as opposed to he was way too early. But that was a situation surely where I was way too early on the call, and I missed out almost on an entire bull market. I was recommending really just being in treasuries and being in very safe instruments, and we saw the stock market doubled in that whole 5-year cycle. So that was a period where I was deliberately, and you could argue stubbornly, bearish. That's when I really caught the moniker of being the perma-bear. Although people who have looked at my track record in the 80s and 90s when I was actually bullish during most of the Reagan era and into the Clinton era, but when I took the podium at Merrill Lynch and I had the megaphone, I got viewed as a perma-bear because I started off bearish and I stayed bearish right throughout that bull market. I think I did a better job this last time around, although I do think this is another cycle in a different way that was built on straw as opposed to brick. We once again globally, not just in the U.S. but globally, took an economic cycle and recreated a whole bunch of new leverage on top of what was already a debt bubble to begin with that got unwound in spectacular fashion in the last cycle. But I understood earlier this time, not that I was early to the cycle, I didn't start to turn really bullish till 2012, so I missed out on the first couple of years. But once I figured out between zero rates and all these relentless quantitative easings, and I had made a pledge to myself that I was not going to miss out on the entire rally this time around like I did back in 2002 to 2007, I realized how important central banks play a role, more today than ever before, in suppressing risk premia. And even though that leads to an inherent misallocation of resources, the reality is that so long as the central banks have the deep pockets and are at the poker table as long as they have been with the rest of us, they have a massive influence, on liquidity, but also on relative valuations because of their control over the interest rate structure. So that's really, I think, the learning lesson. I missed 100% of the rally from 2002 to 2007. I caught 50% of it this past cycle, and in the next bull market, hopefully I'll get that number closer to 75% and show progress in calling the sunny days as opposed to just the storm clouds rolling in.
Well, thank you very much for sharing that with us, David. So as we begin to wrap up the show, is there anything else currently on your mind that you'd like to share with our listeners today?
Well, I think that the most important item that I would like to share is that we have hit the peak on the interest rate cycle. We've hit the peak on the economic cycle. Whether or not central banks, including the Fed, have caught this in time, only the lags in history will bear that out. But my sense, the most important factor, and probably my highest conviction call, is not a recession, is not necessarily a bear market. It's the conviction is that interest rates are going down from here. The process has already started in the past few months, and we're going back into a period where bond yields will be going down. Monetary policy will be eased. We'll have to wait and see if it works or what central banks will have to do to either prevent a recession from coming or certainly mitigating whatever damages a recession may bring. But we are into a new chapter on the cycle, and it's one that's going to involve much lower interest rates. And the bond market is already giving you that signal, and it's something that I would willingly embrace in terms of ensuring that the portfolio, whether it's in equities or whether it's in real estate or whether it's in fixed income, I think that we're going to be seeing that the emphasis will be on recurring cash flows and stable income, and that will be the strategy du jour for at least the next 12 months.
Okay, well, thank you very much for your time today, David.
Thanks again.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?